All right, let's get right into it. Picture this. A single idea, just a little tremor in the tech world, sends massive shockwaves through a multi-billion-dollar investment firm. So much so that people are literally scrambling for the exits. This isn't some movie plot. It's exactly what just went down in the high-stakes world of private credit.
You know, it's pretty much the ultimate nightmare scenario for anyone in finance, right? It's a classic run on the bank, except in this case, it's a run on a massive fund. And it really makes you wonder, what on earth happens when fear goes viral and a whole bunch of investors all try to cash out at the exact same time?
So the main character in our story today is Blue Owl, a huge player in the private credit market. And in the first quarter of 2026, they suddenly found themselves in a really tough spot. A huge chunk of their investors all at once decided they wanted out, and that created this unprecedented challenge for the firm. The stakes? Incredibly high.
So what was it? What caused this sudden freakout? It wasn't your usual suspect, like a market crash or some big corporate scandal. Nope, the root cause was something way more futuristic and, honestly, for a lot of people, way more unsettling. So let's dig into what's being called the AI fear factor.
This anxiety didn't just appear out of thin air. It was kicked off by a technology that is, let's be honest, completely dominating the headlines and reshaping entire industries right in front of our faces. It's this incredible force for creation, but also for, well, disruption.
And there you have it, straight from the horse's mouth, Blue Owl's own letter to its shareholders. The culprit was artificial intelligence. More specifically, it was this growing fear that AI could completely turn the software industry on its head, making some really established companies worthless, like almost overnight.
You can really see the domino effect here. It's a pretty simple but terrifying chain of logic. First, there's the threat. AI might make a ton of existing software obsolete. Then there's the exposure. Turns out private credit funds like Blue Owl's have loaned billions and billions of dollars to these exact same software companies. So, if you're an investor, what's the logical conclusion? Yikes, my money is in real trouble.
And we're not just talking about a vague feeling here. You can actually put a number on this risk. According to an analysis from Jefferies, software companies make up about 20% of the entire portfolio for a lot of these funds. That is a massive slice of the pie to suddenly have a giant question mark hanging over it because of AI.
Okay, so we get why people were scared, but let's talk about how scared they were, because the numbers we're about to look at are frankly staggering. They went through the roof.
First up, let's look at Blue Owl's flagship fund. It's a monster, a $36 billion fund called OCIC. In just one quarter, they got withdrawal requests for nearly 22% of all their shares. For a fund that big, that number is it's absolutely huge.
But wait, it gets even more wild. They have another, smaller fund that's more focused on tech called OTIC. For that one, the redemption requests hit an astonishing 40.7%. Just let that sink in. In 3 months, investors tried to pull out almost half of the money in that fund.
I mean, just look at the jump from the quarter before. It shows you just how fast this panic spread like wildfire. In their main fund, requests rocketed from 5% to almost 22%. And in the tech fund, they went from an already high 17% to over 40%. It wasn't a gradual thing. It was a sudden, vertical spike driven by pure fear.
So you've got billions of dollars trying to get out the door. Blue Owl is looking at a full-blown crisis. How do you stop a stampede without making everyone panic even more? Well, you do the only thing you can do. You hit the brakes.
The firm did exactly what these kinds of funds are designed to do in a situation like this. They pulled the emergency lever, they activated a safety measure, and put a hard limit on how much money investors could actually withdraw. Think of it like a bank temporarily halting withdrawals during a bank run to make sure the whole thing doesn't collapse.
And the tool they used is called a redemption cap. It's basically a rule that's in the fine print. It says, hey, no matter how many people ask for their money back at once, we're only going to pay out a certain percentage of the fund's total value this quarter. For Blue Owl, that cap was set at 5%.
Now, from Blue Owl's point of view, this whole thing was a massive overreaction. You can see it in their letter. They basically said, look, we get that everyone is spooked about AI, but all the chatter and panic out there just doesn't match up with what we're actually seeing. Our companies are doing fine. They truly believe the fear is totally disconnected from reality.
And just to give you some context here, Blue Owl wasn't doing something crazy or unusual. While the number of people wanting their money back was way higher for them than their competitors, that 5% cap is pretty standard in the industry. Most other big firms were using the exact same limit, though you had a few like Blackstone that let a little bit more money out the door.
So let's just zoom out for a second.
this whole episode wasn't just about one company having a bad quarter. It's a really fascinating look at how these abstract fears about the future of technology can have very real, very immediate consequences in the financial world. So what's the big takeaway here? Well, I think there are a few key lessons. First, boy, can investor sentiment turn on a dime. Second, this AI revolution isn't just a story for tech nerds. It's a finance story, and it's creating some deep, real anxiety. Third, these funds have safety valves like redemption caps for exactly these kinds of moments. And here's a really important point. Even though the panic was real, it was still a minority. In that huge main fund, a full 90% of shareholders didn't even try to sell. They stayed put, which tells you the fear wasn't completely universal.
And all of that leaves us with a really big question, doesn't it? Was this whole thing just a fire drill? A really intense stress test that actually proved the system's safeguards work when you need them? Or is this the first tremor of a much larger earthquake? A real warning sign that the entire trillion-dollar private credit market might not be ready for the disruptive age of AI. That right there is the multi-billion-dollar question.